I think one of the reasons you're seeing gold catch a bid is partially because I think there are a lot of traders in Japan who figure the BOJ is going to have to turn around and go back to yield curve control, which should be very, very bullish for gold. But what you see happening here is an interesting phenomena. You know, the Fed is trapped between inflation and keeping rates down. I don't know how they'll do both, but you can see the market perhaps is even stronger than the Federal Reserve. And what's really interesting about all of this is that gold is moving up in the face of rising interest rates. Now, we're always told that rates go higher, gold goes lower, the inverse correlation.
The global economy is unraveling fast. Central banks are stuck with no good options, inflation refuses to quit, and debt levels are spiraling beyond control. The old rules aren't working anymore, and the markets are starting to show real cracks. Right now, gold is doing something unexpected. It's rallying hard, even as interest rates climb. That breaks decades of logic, and it demands attention. For gold enthusiasts, this looks like confirmation. The metal is reclaiming its role as the ultimate safe haven. But for skeptics who say gold's just a relic, this surge is a red flag that the financial system is under serious stress. Investors are fleeing traditional assets and flocking to something tangible because they're starting to question everything they thought they knew about money and markets. The Federal Reserve faces a trap: raise rates and risk crashing the economy, or hold back and let inflation spiral. Meanwhile, Japan's likely to return to yield curve control, flooding the system with cheap money once again. These moves are fueling gold's unexpected rise and rewriting the playbook on inflation and interest rates. In this video, bullion dealer Andy Schectman cuts through the noise. He explains why gold is rallying against the odds and what it means for the future of money. Whether you're a hardcore gold supporter or a skeptic still watching from the sidelines, this is one signal you can't afford to ignore. Like, subscribe, and share if you want to stay ahead of the next big move. The era of certainty is over.
Yeah, it was the worst 20-year auction perhaps in history, from the way that I look at it. In fact, I think it is the only the second. Let me put it this way: it may be the first or the second highest yield for a 20-year bond auction in history. There may have been one other. I read about it an hour or two ago, and it talked about it being over 5%. And I could have sworn it said it was the worst in history, if not the second. And, you know, you're witnessing, whether it be here or in Japan or in the UK or all around the world, the bond markets are in very big trouble. I think the concept of owning debt from an insolvent country, one that is irresponsible with their fiscal policy, even in the face of Doge, asking to raise the debt ceiling once again. This is emblematic of what we just saw just the other day, where the Fed had to come in and quietly, in what they call stealth mode, I guess, where they're not calling it QE, bought 43.6 billion worth of treasuries in 1 week, 20 billion in 3 year, 34.8 billion in 10 year, and 8.8 billion in 30 year. The Fed is coming in because no one wants to buy our treasuries at these levels. And you can see it here on the 20-year. That's probably why the market turned around and threw up the way that it did. And you can look at the Japanese market, same thing. You know, I think there is a certain segment of the Japanese population, forget about the unwinding of the Japanese carry trade. I mean, that's very detrimental in and of itself. We saw what happened a month or so ago when rates in Japan first started to move and everything calmed down. But here they are moving up again. And I think one of the reasons you're seeing gold catch a bid is partially because I think there are a lot of traders in Japan who figure the BOJ is going to have to turn around and go back to yield curve control, which should be very, very bullish for gold. But what you see happening here is an interesting phenomena. You know, the Fed is trapped between inflation and keeping rates down. I don't know how they'll do both, but you can see the market perhaps is even stronger than the Federal Reserve. And what's really interesting about all of this is that gold is moving up in the face of rising interest rates. Now, we're always told that rates go higher, gold goes lower, the inverse correlation between the two. But when you factor in what or who's issuing the debt, I was listening to a Bill Fleckenstein interview, and he said, on Wall Street, we used to call that a who to problem. Who do we sell it to? And I think that's the issue, is that, we're finding a pool of a diminishing pool of interested parties to buy our treasuries. And it's funny, you see China, who is now slid to number 3 in treasury holdings, replaced by the United Kingdom. Vince Lancy had a great analogy. He said it's like two drunk guys holding each other up from falling. You have, the largest debtor nation buying debt or selling its debt to the second largest debtor nation, or real darn close to it anyway. So two broke nations buying each other's debt, as the rest of the world seems to be favoring things like commodities and cryptocurrencies or whatever the heck they can get their hands on that are tangible, copper or silver, gold or platinum, which we saw a microcosm of a short squeeze yesterday and a little bit today. And I think that's on a larger scale what you could expect to see in the silver market. But yeah, it's an interesting time right now. And certainly I think it focuses squarely on the bond market. That's where really the trouble lies.
As we've seen, the bond market turmoil is shaking investor confidence worldwide. Adding fuel to the fire, Moody's recent downgrade of the U.S. debt rating has only intensified concerns. This isn't just another routine rating update, it's a stark warning about the growing risks tied to America's mounting debt and fiscal mismanagement. Moody's warns that by the mid-2030s, debt-to-GDP ratios could soar above 130%, and interest payments could consume nearly a third of government revenue. This grim outlook suggests that the U.S. government's ability to manage its debt sustainably is under serious threat. The downgrade challenges the long-standing assumption that U.S. Treasuries are a safe haven. It raises serious questions about the government's ability to service its obligations without drastic consequences. Investors are now forced to rethink where they put their money, and that shift is sending shockwaves through global markets. Next, Andy breaks down what the downgrade really means, why it came now, and how it factors into the bigger picture of bond market stress and gold's rising appeal. The stakes have never been higher, and understanding this is key to grasping where the economy is headed.
I don't know why they decided to do it now, right when you have an administration actually addressing the irresponsibility and the corruption in basically the evisceration of our currency through ridiculously irresponsible programs that the government has spent our money on. Now they want to do it, not before this. I think Moody's is kind of nonsense, to be honest with you. But they talk about a warning of a debt to GDP hitting 134 by 2035. But the truth of it is, if we add in the unfunded liabilities, we're well north of 200. And, they say an interest burden will consume 30% of the revenue by 2035, up from 9% in 2021. Well, the Congressional Budget Office also said by 2031, every penny of tax revenue will go just to pay the interest on the debt, and these mandatory off-balance sheet entitlements, Social Security and Medicare as an example. So anything that's discretionary, like military, which is $1 trillion bill this year, will be borrowed. And at what point do we realize that the world has lost appetite for the Treasury? So who's going to buy it? It's that who to problem again. Who are you going to sell it to? And when you see the Fed come in and not even admit the fact that it is quantitative easing, that they are buying treasuries, and they do that, they're trying to plug a hole in the dike to keep the bond market together and to keep this from accelerating. But, this is a real problem. At some point, the irresponsibility catches up with you. At some point, the way that we behave on the international stage, the tariffs, the threats, the sanctions, the spending, the borrowing, the raising of the debt ceiling, on and on and on. At some point, I think the attractiveness of our debt looks silly. And anyone who would hold duration of any length greater than 6 months or less, I think is a fool in this market right now. And the bond market is proving that to be true. And again, it's really interesting that as rates are going up, so too is gold. Gibson's paradox speaks to the inverse relationship between real rates and the price of gold. And as rates continue to rise, even if we have to suspend the fact that we know that the CPI is a bunch of crap, but let's just take it at face value. That's what the market uses. Well, as the rates right now are certainly over the CPI, that is a return, a real return. One would expect that gold, which does not pay a real return, should be retreating. And one of the hallmarks of this market that is vastly different, Dunnigan, than anything I've seen in 35 years is, it's kind of like a fight in high school where, you hit the kid, he never gets back up. You're watching two kids fight. One hits him, he never gets back up. But this time the kid keeps getting back up. He gets hit and he gets back up. He gets hit and he gets back up. And I've never seen that before. Maybe that's a bad analogy. But the point of it is that it never did this. It would get hit and it would be down for years and sometimes even longer than that. And you look at 2011 when it hit $1,900 and it was down for a long time, 8 years or so, 7, 8 years before it finally came back. And but this time seems to be different. It goes down $100 or $200 and comes right back up. And the demand in Asia is overwhelming. And you can see it. It's almost as if the Chinese now are controlling the price of gold.
This is a wake-up call. The financial system is under siege like never before. Debt downgrades, collapsing bond markets, and soaring gold prices are flashing red warning signals. The old safety nets are unraveling, and the consequences will be severe if you're not paying attention. We're witnessing a perfect storm where governments keep piling on debt they can't repay. Central banks are running out of tools, and investors are losing faith in what was once considered rock solid. This isn't some distant crisis. It's happening right now, shaking the foundations of global finance. Gold's relentless rise amid rising interest rates is a clear sign that the old rules no longer apply. The market is sending a loud message. Trust in traditional currencies and bonds is fading fast. The fallout will be felt across every sector, from your retirement savings to the cost of living. You can't afford to ignore these developments. Stay informed, stay prepared, and make sure you're positioned to protect yourself and your assets. Subscribe, like, and share this video, because this story is far from over, and the choices we make now will shape the future for years to come. Thanks for watching, and see you in the next one.